Australia's Treasurer, Jim Chalmers, made some significant announcements recently.
It's about boosting housing stock and getting more homes onto the rental market. First of all, tripling foreign investment fees for established homes, then doubling the vacancy fee for homes owned by foreigners.
The highlight of the announcement was the changes in fees for foreigners purchasing houses and the penalties they will face if they leave these properties vacant,
making it more expensive for people to leave them empty.
The government tripling foreign investment fees for established homes, doubling vacancy fees for overseas investors.
This conclusion was reached as an attempt to tackle the rental crisis and ramp up the housing supply in the country.
Congratulations. Ladies and gentlemen, have a great afternoon.
The second least affordable housing market in the world among 94 major cities.
The toughest market I'm finding for buyers are the low-income first-home buyers, and they're often looking at one-bedroom or two-bedroom apartments, because you can imagine when rates go up from 2% to 6%, that's huge for someone who's on a single income salary, looking to buy their first home.
A staggering 1.82 million Australians now face the risk of financial strain, with mortgage payments swallowing up to 45% of their post-tax income. The capital cities of the country grapple with home prices skyrocketing to near $1 million medians, and this wasn't always the norm. How did Australia reach this point in its housing crisis, and why does it matter to the rest of the world? Join us as we delve into the details of the alarming situation. Jim Chalmers mentioned that charges for foreign investors buying established homes will triple, and those who keep these properties empty will face double penalties. Simultaneously, the application fees for investing in build-to-rent projects will be reduced to encourage foreigners to engage in constructing new properties. The Australian government, led by the Labor Party, plans to introduce these new laws in the coming year to address the scarcity of available housing, which has caused immense difficulties for many renters struggling to secure suitable accommodation. As the housing supply continues to dwindle, rental prices across the country have surged by a substantial 7.6% in the year leading up to September 30, marking the most significant increase in 14 years, according to official data. Treasurer Jim Chalmers emphasized the severity of the issue, noting the striking number of empty properties across Australia. He stressed the urgent need for more homes to accommodate Australians who are in desperate need of housing, expressing these concerns in an interview with Sky News Australia. But what's causing this upward trend in prices? Let's first dive into the specifics of the situation in Australian cities, which are among the most challenging globally. For instance, in Melbourne, the average home recently hit a record high of $1 million. A typical home in the city now costs 7 figures. Sydney, Australia's largest city, is even more staggering, with an average home price of $1.4 million. But measuring housing affordability isn't just about house prices. It's about the overall cost of owning a property compared to household income, also known as price-to-income ratio. A healthy ratio typically falls between 3 to 5 times someone's yearly income. If you make $60,000 a year, your search for a place ideally falls within the $180,000 to $300,000 range. Looking at the list of the world's top 10 cities with the most expensive price-to-income ratios, you will find that Melbourne ranks 9th, with houses almost 10 times the median yearly income. Also, Sydney holds 2nd place, reaching nearly 13 times the median income. This housing affordability problem in Australia isn't a sudden issue, but has worsened over decades. Historically low interest rates over the last decade made borrowing money easier, enticing people to invest in properties. But as more people and investors bought properties, the market supply dwindled. The pandemic made things worse when interest rates dropped even more. When it hit in March 2020, the Reserve Bank of Australia slashed the official cash rate from 1.5% to 0.25%. By early 2021, it further dropped to 0.1%. This move, essentially allowing banks to borrow money at very low rates, led to reduced interest rates on mortgages for customers. Mortgages that previously had 4 to 5% interest rates now dropped to 3 to 4% or even as low as 2.2% for a 2-year fixed rate. However, By mid-2022, the Reserve Bank had to address another concern: inflation. Interest rates shot up to 4.1%, causing that 2.2% mortgage from 2021 to rise to 6.5 to 7.5%. This shows a clear connection between interest rates and the property market. Since then, national home prices in Australia shot up by 33%. Meanwhile, renting costs across the country skyrocketed faster than inflation and wages. We're now stuck in this peculiar time loop where everyone's hoping for prices to dip, but they're relentlessly climbing. And it's because high interest rates are deterring sellers from swapping their lower rates for higher ones, causing a scarcity of available homes. Reports even indicate that the number of properties sold at a loss within a short time frame increased from 2.7% to 9.7% by June 2023. Nearly 10% of these properties, purchased and sold within 2 years, were sold at a loss. That's a sign of necessity rather than choice. There might also be a lag effect where people take months or even up to a year before deciding to sell a recently purchased property at a loss. In addition to the increase in interest rates, Australia's population has been ballooning for years, especially in major cities like Melbourne. Back in 1971, Melbourne had 2.6 million residents, but that had almost doubled to 5 million by 2021. And it's not stopping there. The Center of Population Projections estimates a yearly growth rate of 1.6 to 2.1% until 2033. That means Melbourne is headed for another 1 million residents within a decade. A big chunk of this growth is from overseas migration. Australia's diverse culture and its thriving economy have attracted people from all over the world, and it's evident why so many people want to call Australia home. The Economist Intelligence Unit even ranks Melbourne and Sydney among the top cities for quality of life. Unfortunately, the surge in population naturally pushes up property prices. More people mean higher demand for housing, which drives up rent. Higher rent increases property values because the same property brings in more income. In theory, this rise in prices should lead to more construction, eventually increasing housing supply and lowering prices again. Increased migration and investment should ideally lead to more property development, keeping prices in check. However, in the real world, we're not witnessing enough property development, which keeps supply tight and prices soaring. Part of this scarcity is due to post-pandemic consequences. Building a house has become around 30% pricier than pre-pandemic times. Inflation has jacked up construction companies' material and labor costs, leading to many bankruptcies. Over 1,800 construction companies went into administration between July 2022 and April 2023. Beyond the pandemic's impact, there's a natural limit to building new homes in big cities. Demand for property usually extends from the city center, but there's limited space around the Central Business District, also called CBD. So, where does that leave us? There's this ongoing struggle to balance the demand for housing with limited physical space, especially in cities. To address this problem, developers have been constructing towering apartment buildings. As we move away from the CBD, though, there's more space, leading to single and double-story homes, larger yards, and ultimately lower home prices. But should they permit more apartments in quieter suburbs to boost supply, or restrict large developments and witness housing shortages drive prices up? The coming months or a year ahead are pretty uncertain for the Australian property market. Another measure the government is taking is with foreigners buying properties, which was discussed earlier. Foreigners going to Australia for work or study typically have to sell their homes when they leave. Right now, when they buy an existing home, they pay a foreign investment fee. For instance, for a median price home in Sydney, which stands over 1 million Australian dollars, this fee is around 28,200 Australian dollars, which is 18,500 US dollars. But now, the plan is to amp up these fees. The foreign investment fee will be tripled, and foreign owners who leave their established homes vacant for over 6 months will face a higher annual vacancy fee. This fee will double, reaching the same level as the foreign investment fee. This translates to a 6 times increase in annual fees for foreigners who keep existing homes empty. The government expects these changes to rake in about 500 million Australian dollars, which could be directed toward crucial areas like housing, as Chalmers explained in Brisbane to reporters. There are lessons to be learned by other modern economies like the US as the housing crisis in Australia intensifies. For example, the capital gains tax discount. This policy states that if you hold an investment like a property for over a year and sell it for a profit, you only pay half the capital gains tax. That is, you only pay tax on half of the profit made. For those in the highest tax bracket, that's a significant cut. Critics argue this policy hugely boosted home prices after its introduction. Then there's the negative gearing, a policy that favors capital. If your investment property costs more than what it earns, you can use that difference to deduct from your taxable income. For instance, if you make $100,000 yearly and your property generates $10,000 but costs $20,000, you can use that $10,000 loss to reduce your taxable income. This policy grants an unfair tax advantage. Combining both policies encourages those with capital to take loans, get tax breaks, rent out properties, and benefit from their increase in value. The focus on capital has led countries like Australia to face a rental crisis. Demand for rentals far outstrips supply, with less than 1% of rental properties available. Rents for houses and apartments surged by 16% and 20% respectively in the past year. Sadly, the young and lower-income individuals are hit the hardest. Financial stress affects 1 in 5 working households renting, leading to tough choices like skipping meals or not heating homes. This shift also impacts future retires. Nearly half of renters aged 65 and older currently live in poverty. Housing costs become a significant financial burden in retirement. For those without a home by 65, retiring might mean living modestly or working longer than planned. In the past, homeownership in Australia was more accessible. In the 1990s, the average Australian saved for a down payment in just 7 years. However, recent data shows that only 40% of people aged 25 to 34 own homes, dropping to 28% for the lowest income bracket. Saving for a down payment now takes an average of 12 years. This trend of increased renting and decreased home ownership is a concerning sign for most contemporary economies. It affects everyone planning for their future, and it calls for immediate attention. Thanks for watching. Hit the thumbs up if you like this video and subscribe to our channel. See you in the next one.